Good morning, everyone. We had a little technical glitch, which is in the process of being fixed. So let me just housekeep for about 3 minutes, and then Peter Gold will take over, and we'll have the first panel. First of all, the form for CFA members for continuing education credit, if you haven't done so or if you've forgotten to. Jill, where are you? Right here. Okay, that's where the forms go. Secondly, in the back of the program is a listing of conferences and things that the GIC has planned, and they include, there's some flyers out on the table and what have you, but I want to make sure to just mention a couple things. There's a conference at the Philadelphia Federal Reserve Bank next month on women and risk. There's a handout like this that talks about it. Sheila Bair is committed as one of our speakers, and Sandy Pianalto, the Cleveland Fed president, is committed, and it's a first-rate program. It's the first time the Global Interdependence Center has had a meeting like this. And the chair is one of our colleagues of GIC, Mary Caracoli from ABC News. And so it's, for those of you who want to come to Philadelphia and participate, it'll be a great session. In Phoenix, Arizona, Peter Gold has put together a monumental program that really is global in its application and will involve Canada as well as the United States, and lots of discussion on trade. Now, I know Bermuda is a wonderful destination, but Phoenix isn't bad in February for those of you who want to make a trip. And lastly, for the sixth, I think, or 7th year, on March 10th and 11th, we will be back in Paris, and our partner over the years has been the Banque de France. They will again host us on March the 10th, and following the half-day and lunch on the 11th, it looks like, Jill, do we have it confirmed about the archives? Working on it. We have been able twice before to visit the National Archives of France. And it looks like the curator of the archives, who is a GIC member and has been very accommodating to us, the archives had to move. So for 2 years, when they were building the new facility, we were unable to visit. No one was able to visit. And they are now open. We were able to do this the last time we were in Paris, and in the works is the possibility. The reason I say that is, assuming that program comes together, and having done this twice, I will tell you it is very exciting to see the Treaty of Versailles in the original form, and other documents like the congratulatory letter that George Washington sent to the new government of France. And in my own personal experience, the first time we went just to see the Franco-American Treaty, which was the first treaty signed by France and the first treaty signed by the United States. Ben Franklin signed on behalf of the United States and Vergennes on behalf of France. And on her own, the curator of the National Archive took out, and there was a table. We were in you went through security twice, and you were in a humidity, temperature-controlled environment. And on her own, she took out a few things, and they were sitting on a table. And afterwards, she gave us a lecture for about 20 minutes on the Franco-American Treaty, which was forget all the economics, central banks, cities, debt, just that was worth the trip. And then she said, and I thought you might be interested in seeing a few other things. Now, here we're looking at a 300-year-old anniversary of Ben Franklin and all that. And so here are the other documents. And she actually took them out except for the plastic cover. So we're standing around this table and pointing out some things. And she said, you can pick them up very carefully. So I pick up this document, like this. And my French is poor, but it's enough to read it. And I begin to read it. And I said, Isabel, I said, is this the Louisiana Purchase? Is this signature? Is this it? So she says, yes, monsieur. She says, there were 2 copies, one in English and one in French. This is the one, this is ours, you have yours in your archives. I said, my God, the Louisiana Purchase. She says, monsieur, here we say it's the Louisiana Sale. So you try to be quick-witted, and I said, Madame, this would make a wonderful souvenir. And she smiles exquisitely and elegantly in French, and she says, that is why I have a copy for you. So you're welcome to come to Paris, and there's a very good chance we'll be able to go back to the National Archive. And in addition, we'll talk about central banks and money and finance and economics and the condition of the world. Now, we're doing something else this time that we have not done before, but given all the news in the world, this session this morning is focusing on cities in many aspects. And we have a stellar lineup. It is being videoed now. The video will be digitized, available to the whole world through the GIC website. And because, again, for those who didn't hear yesterday, the only reason we're not streaming it live is a firewall issue in the internet connection in this hotel. It'll be available. I don't know when, Jill. When will that be completed? Next week? Okay. And who's doing it? The lowest bidder? Yeah, okay. So without further ado, my colleague, good friend, GIC board member and supporter, sponsor, Peter Gold will introduce our first session. Thank you.
Thank you, David. So let me add my welcome to that of David's and welcome you to our session on the future of American cities, subparts, can cities be saved, and insuring the cities. Maybe they're the same question, maybe they're not. We're going to look at this question, this issue this morning, first through the lens of Detroit, and perhaps understand some of the factors which occurred there and looking forward. Former Mayor Dennis Archer will guide us through that exercise, and there's, I would say, no one more qualified to do that. Then Mary Francoeur from Assured Guaranty will provide her views through the municipal bond, municipal finance, bond insurance focus on the cities today, tomorrow, perhaps some of the underwriting factors that will be used, are being used in those considerations. By way of introduction of the panelists here this morning, I just would like to invite you to the booklet, which has a much fuller bio of each of these presenters than I'm going to review. But I did want to note 2 things and a few things about each of them as we move forward. And the way we're going to do this morning with the panel's concurrence is the mayor will first have his presentation, and then Mary will present. So by way of just very broad introduction, I really, when I met Dennis Archer, didn't know how to address him, because he could be a mayor, addressed as a mayor. He could be addressed as a justice of the Michigan Supreme Court. He can be addressed as chair of a major distinguished law firm. He could be addressed as former president of the American Bar Association. But he also could be addressed as the elementary school teacher, which he was for 4 or 5 years, if I've got that right, and assisted and helped learning disabled children. And he could also be addressed as a husband, a father, and a grandfather. And how are you this morning? So many ways, but I also learned through the period of time I've been with him to address him as a wonderful, wonderful, knowledgeable person in this field, and hopefully a friend. So our next person that I'd like to just talk very briefly about, Mary. Her bio is also in the booklet, as I indicated. But Mary is responsible for business development and underwriting Northeast U.S. public finance and project finance and utilities in the Americas. And she has broad experience in this area and is highly regarded in the field and esteemed in her expertise. What I'd like to do now is sort of depart from just asking the mayor to come up. I'd like to a little bit set the stage and take you back a few years in Detroit's history, if I might do that, and sort of create a little picture for you just very, very briefly. So keep these things in mind, please. I invite you to remember these facts. So Coleman Young was mayor of Detroit from 1974 to 1994. And Mayor, correct me, please, if I get any of this wrong. Dennis Archer was mayor from 1994 to 2002, and Kwame Kilpatrick was mayor from 2002 to 2008. And just yesterday, the New York Times at least reported today that former Mayor Kilpatrick was sentenced to 28 years for corruption in a verdict, following up on a verdict from earlier in the year. Now, according to the Detroit Free Press, there was an interesting article, I found it interesting, on October 3rd entitled, "How Detroit Went Broke." It was a very long article, very, very data-heavy article. And there are just two observations that article meant that I wanted to share with you this morning. So first, in the period of 1995 to 2000, housing values in Detroit increased dramatically. These are just direct quotes from this particular article. And the other one, which I thought was very interesting, is by the year 2000, quote, "Wall Street's outlook for Detroit is the strongest in 20 years." Assured Guaranty and Detroit, as I read some of the statements as of July 2013, and please, Mary, correct me if I have any of this wrong, because I do not want to in any way, don't know if it's been updated, but Assured Guaranty insured net par of $793 million of water revenue bonds, Detroit's water revenue bonds, $1 billion of Detroit's sewer revenue bonds, $395 million of general obligation bonds. And then the last thing I want to say, and I'm going to ask the mayor then to start his presentation, is this is the Global Interdependence Center, and what is happening in Detroit and perhaps in a few other cities is actually touching many parts of the world. So there was an October 3rd AP article which basically starts out this way. When Detroit's bankruptcy was imminent this summer, hedge funds were aching for the chance to snap up $1 billion of the city's debt sitting on the balance sheets of European financial institutions. If the funds could buy it cheap and then cut a deal with the city, they stood to make a tidy profit. The banks were hoping to get 46 cents on the dollar for their debt, however, with funds bidding around 40. But most, however, would prefer to purchase the debt themselves, the banks, which rest on a shaky legal foundation for them to be able to do that. Then the European financial crisis, according to this article, developed even more pronouncedly. Many of these banks are now under pressure from regulators to protect their balance sheets. So the conclusion of this particular author is the defaults of Greece and Detroit are often compared superficially, but few expected that the costs of the European debt problems would be felt on the streets of Detroit. So with that, thank you, and I'll turn over to the mayor.
At the outset, let me invite everyone to go to the website where my remarks, complete with endnotes, will be available in about a week. I say that because I not only put what I feel into my remarks, but also I've drawn upon the wisdom of others, and I want to be very accurate and to make sure that you know where I got my material from. Can cities be saved? Given my professional experiences, I can declare, yes, cities can be saved, but they cannot be saved without recognizing and addressing the causes of their financial distress. In 1975, the city of New York was $14 billion in debt and had a deficit of about $2.2 billion. New York City was facing bankruptcy. Congress and President Gerald Ford approved $2.3 billion in short-term loans, required dramatic fiscal restructuring to get the city's books in order. Through those federal actions, the threat of a bankrupt New York was avoided. Today, we do not have a Congress like the one in 1975. A number of cities are currently facing fiscal challenges. Cities like Chicago, Los Angeles, and Baltimore are reportedly facing major financial problems, in part because of large unfunded liabilities in pension and health care payments to retirees. According to the New York Times, the pension fund for retired Chicago teachers is on the brink of collapse. Moreover, the city's 4 funds for other retired city workers are short by $19.5 billion, and at least one of the funds is in peril of running out of money in less than a decade. Worse yet, starting in 2015, the city will be required by the state to make far larger contributions to the funds, which could leave it hundreds of millions of dollars in the red, as much as it would cost to pay 4,300 police officers to patrol the streets for a year. Time magazine's August 5th, 2013 issue focused on Detroit's fight to survive and asked, is your city next? It reported that Fresno had a budget shortfall of $4.2 million, North Las Vegas had a budget deficit of $18.8 million. Philadelphia had a debt obligation of $9 billion. Birmingham had a budget deficit of $30 million. And New Orleans had a debt obligation of $1.9 billion. According to James Spiato of the law firm of Chapman and Cutler, there have been only 302 local government Chapter 9 filings in the United States since 1954. 62 were by cities, towns, villages, or counties, and the rest involved special tax districts, utilities, hospitals, and school districts. There have been 8 general-purpose local government bankruptcy filings between 2010 and September 1, 2013. There were Boise County, Idaho, the city of Central Falls, Rhode Island, the city of Harrisburg, Pennsylvania, Jefferson County, Alabama, the city of Stockton, California, the town of Mammoth Lakes, California, the city of San Bernardino, California, and the city of Detroit, Michigan. When Detroit filed for bankruptcy on July 18, 2013, it was the largest city to file for bankruptcy protection. When Detroit filed for bankruptcy, it reported $18 billion in liabilities, Most people were aware of Detroit's $3.5 billion unfunded pension liability. However, they were surprised to learn that Detroit faced a $6.4 billion in post-employment benefits, OPEB, which were mostly obligations to pay health care premiums for retired public employees. The Pew Charitable Trust in January of 2013 examined the pension and OPE shortfalls of the 30 largest cities in the United States. The unfunded pension deficit for those cities was $99 billion, but the deficit of unfunded retiree health care benefits was $118 billion. Part of the reason that OPE deficits are higher than pension deficits is that the OPEB liabilities were for many decades simply not reported by municipalities. In 2006, the Government Accounting Standards Board, GASB, required local governments to report their OPEB liabilities. However, GASB did not require cities to fund their OPEB deficits. Thus, almost all cities have only minimal advance funding for their health care obligations. These obligations are almost always financed on a pay-as-you-go basis. In my view, there were at least 6 major and 2 contributing reasons the City of Detroit, through Governor Rick Snyder and his emergency financial manager, Kevin Orr, filed for Chapter 9 bankruptcy protection. The major reasons were: 1, the failure to regularly monitor the revenues of the city before authorizing expenditures; 2, failure to have realistic budgets; 3, the mortgage debacle, which substantially reduced the property values in the city and thus its property tax revenue; 4, the loss of manufacturing jobs, which started when gasoline rose to over $4 a gallon and which severely impacted the income tax revenue; 5, the failure of Mayor Dave Bing and the Detroit City Council to satisfy the consent decree by not presenting Governor Rick Snyder with a plan that would balance and eliminate the city's deficit; and 6, the continued loss of the city's population, which was 25% from 2000 to 2010. The 2 contributing reasons are the state's violation under Governor John Engler and Governor Jennifer Granholm of an agreement to keep the city's revenue share at the same amount for a period of years in return for the city reducing its income taxes on its residents and non-residents; and 2, the reduction of the city's workforce by both Mayor Kwame Kilpatrick and Mayor Dave Bing at $4,000 each in an effort to balance the budget and avoid a deficit, which resulted in the city having 2 retirees for every 1 working city employee. Before I was sworn into office in 1994, Jay Alex, the chairman of my transition team's finance committee, discovered that I was going to inherit a projected $88.5 million deficit with 6 months to balance Mayor Coleman Young's budget. By regularly meeting with my budget director, Ed Hannon, and finance director, Ed Rago, along with my department directors, we balanced Mayor Young's budget. We produced realistic budgets thereafter each year and balanced our budgets going forward, and we had a modest surplus each year. There are 2 principal sources of revenue for the city's general fund budget: city income taxes and property taxes. We constantly monitored both to assure revenue before authorizing expenditures. The city's overall budget, including the federal funds, was about $3.1 billion a year. After Mayor Kilpatrick, who succeeded me, took office, his administration issued $61 million in fiscal stabilization bonds. It was the first of several bond issues that Kilpatrick urged to support the city budget. Kilpatrick never built realistic budgets. He added city workers, but later had to cut them. His first response to budget challenges was to borrow, and the chronic annual deficit spending started under him. In 2005, Mayor Kilpatrick lobbied City Council to borrow money, $1.44 billion to eliminate the city's underfunded pension liabilities. The mayor said if Detroit's pension obligations were not addressed, he would be forced to lay off 2,000 employees. He estimated the city could cut $277 million a year from its pension obligations and prevent these layoffs by selling pension obligation certificates of participation and putting that money into the city's pension funds. He sought to render them nearly 100% funded. In addition, the city also brought derivatives or swaps in a complex Wall Street financial transaction that permanently locked in steady interest rates around 6%, which at the time was a reasonably good rate. 3 years later, in 2008, interest rates tanked, the stock market essentially collapsed. With its credit rating downgraded and in desperation, Detroit pledged its casino tax revenue as collateral to creditors to avoid a $400 million payment that, in 2008, would have forced Detroit to file for bankruptcy. Detroit, as a result, owes $2.8 billion for principal, interest, and insurance payments over the next 22 years, based upon a review of the city records by the Detroit Free Press. That bill is enormous in part because for about 5 years, the city made only interest payments. Things really got ugly as a result of that, said Rago, the former budget director. In the end, as you really could look back on it, it was the worst thing they could have done. The Kilpatrick administration borrowed another $6 billion for water and sewage infrastructure. Mayor Dave Bing inherited a $315 million city deficit. Worse, Mayor Bing faced the challenges of a national recession, a mortgage crisis that substantially reduced property tax revenue to the city's general fund, and a loss of manufacturing jobs that substantially reduced the income tax revenue to the city's general fund. In 2009, at Mayor Bing's urging, the city issued $250 million in fiscal stabilization bonds. At that time, the city was almost out of cash, and borrowing could not be avoided. Mayor Bing and City Council could not erase the deficit that had accumulated. Perhaps their efforts would have worked if the city had not lost 25% of its population from 2000 to 2010, and along with its residents who would have paid income tax and property tax into the general fund. In 1988, Governor John Engler and I agreed upon a deal in which the state of Michigan would freeze Detroit's $333.9 million of revenue sharing funds for 9 years if the city would reduce its income tax on residents and non-residents, which was the highest in the state. Ken Cole, the city's longtime lobbyist, former reporter for the Detroit News, and current member of the Bridge Board Advisors, summed it up this way. The state of Michigan broke its promise to Detroit, according to Cole. Detroit lost $220 million in revenue sharing, as well as $433 million to $508 million in income tax it was not permitted to collect. Governor Engler, who is now president of a Washington, D.C.-based business group, says he was forced to cut revenue sharing a decade ago when he was confronted with the worst state budget crisis in 20 years. These revenue sharing cuts occurred annually after Democratic Governor Jennifer Granholm became governor, and she had to deal with a succession of budget deficits. Although it is easy and convenient to blame Detroit's financial problems on corruption, unions, and overly generous pension benefits, none of those factors was the primary cause of Detroit's bankruptcy. The primary cause was the steady erosion of the tax base through the loss of population and the city's need to borrow money to pay for even minimal levels of public service. What lessons can other cities learn to avoid financial challenges? They can learn from Detroit what not to do. They can learn to make the needed changes now while they're still small and less painful. Don't wait for the crisis happens to get advice. If you wait too long, it's disaster recovery. The sooner you realize you might have a problem, the sooner you address it, it is the better. Observed bankruptcy attorney David Douglas Bernstein at the annual 3-day conference of the Michigan Municipal League in Detroit last month. Given my past involvement and my recent visits to both, I know that the leadership of the National League of Cities and the U.S. Conference of Mayors are focused on what happened to Detroit and how to prevent or avoid similar problems happening to other cities. And what of Detroit's future? The United States Bankruptcy Code has two fundamental goals. First is to provide debtors with a fresh start. The second is to guarantee that creditors are treated fairly and equally. Should bankruptcy judge Stephen Rhodes find that the city of Detroit has proven that it merits Chapter 9 bankruptcy protection, then the city of Detroit will have a successful fresh start. Harvard Business School Associate Professor Eric Worker made the following observations about the differences between corporate and municipal bankruptcy. Cities almost never die. A bankrupt firm's assets can be sliced up, repackaged, and sold off to partially repay the firm's creditors. And once that process is complete, the entity becomes dissolved. But cities cannot just be dissolved. Places recover from all sorts of catastrophes, including natural disasters and wars. Along the spectrum of catastrophic events, a fiscal crisis is not the worst of these. In fact, a fiscal crisis is often an essential ingredient of recovery. Detroit has a precedent in Pittsburgh and a variety of other cities and jurisdictions that have seen their trajectory fundamentally shift in the wake of precipitous economic and fiscal decline. Long before the American automobile industry was in crisis, the American steel producers began to lose out to foreign competition. In the Pittsburgh region, which is to steel what Detroit is to the automobile, some 150,000 jobs disappeared, devastating the region's population of 2.2 million people. Pittsburgh's recovery offers a potential model for Detroit. It went on to become a technology hub anchored in the computer science and robotics coming out of the Carnegie Mellon University. It also became a medical hub driven by the brisk expansion of the University of Pittsburgh Medical Center, and the education centers of Carnegie Mellon and Pitt attracted students from all over the world, and the city helped to retain them through its new economy sectors and affordable home prices. Americans and foreign banks are riveted by Detroit's municipal bankruptcy, which will have serious implications for Detroit's citizens and businesses, pensioners, and creditors. There is room for optimism that may sometimes be overshadowed by the headlines decrying Detroit's bleak and pessimistic future. One point of optimism is that the market momentum in Detroit's core is real and palatable and can provide a strong foundation for future growth. For example, the Detroit Future City Plan has an excellent blueprint for growth and investment. Detroit's core, which is a 7.2 square mile, encompasses downtown, midtown, New Center, and a few other neighborhoods in the city of 138 square miles, is experiencing private and civic investment in business and residential growth. There are approximately 5,400 businesses in that small area of the city, which employs over 135,000 people. Detroit is being transformed by entrepreneurs like Dan Gilbert, founder of Quicken Loans. In 2007, Gilbert moved the firm's headquarters from Farmington Hills to downtown Detroit and now has 7,000 employees downtown and has purchased more than 18 buildings in downtown Detroit, 2 parking garages. That is part of his Detroit 2.0 revival vision, which he describes as a lively live, work, play district in the heart of the city based around entrepreneurial companies in the digital economy. Gilbert's confidence and actions have convinced other firms to expand their downtown presence, and an entire subculture of tech-orientated startup companies such as Digiready, Detroit Labs, Stick have come to Detroit. The Kresge Foundation contributed $50 million to a large public-private reclamation and redevelopment project along the Detroit waterfront. In a like vein, Sue Mosley, who is the president of the community development organization Midtown Detroit, Inc., is trying to revive Midtown Detroit by focusing on 4 institutions: Henry Ford Hospital, the Detroit Medical Center, Wayne State University, and the College for Creative Studies. Henry Ford Hospital just completed a $300 million renovation and announced a $1 billion expansion with commercial, retail, and housing space. The Detroit Medical Center, which employs about 3,000 physicians and numerous other employees, have invested $850 million in a new heart hospital and an outpatient pediatric facility. Wayne State University, which is the largest public research university in Detroit, is building a $90 million biomedical research facility to connect with Henry Ford Health System. Wayne State is also home to TechTown, a technology research center and business incubator. The College for Creative Studies, which is one of the top design colleges in the world, spent $145 million in 2008 to develop the historic Argonaut building. The most recent infusion of capital in Detroit will involve building the M1 Rail, a 3.3-mile light rail line from downtown to Grand Boulevard at the upper edge of Midtown Detroit. It's a consortium of many public, private, and philanthropic institutions, including General Motors, Chrysler, the Kresge Foundation, and individual investors who've committed more than $100 million to the project. United States Secretary of Transportation Ray Hood has said, "Nobody in America, no community has ever raised $100 million for a project like this. This is unprecedented." Lastly, a consortium of entities has pooled resources through a $100 million New Economy initiative. There's currently a plan to build a new hockey arena for the Detroit Red Wings with an investment of $444 million in retail, office, residential, and hotel space with an additional investment of $206 million, all within walking distance of Comerica Park, where the Detroit Tigers play, and Ford Field, where the Detroit Lions play. The Arlington, Virginia-based NCB Capital Impact and the Troy-based Kresge Foundation announced a $30 million fund for developments along or near the Woodward Corridor in Detroit. Essentially, the neighborhoods of Midtown, North End, New Center, Woodbridge, and even Eastern Market. The Woodward Corridor Investment Fund will make loans of $500,000 to $5 million and is expected to result in the development of 450 to 600 rental units in Midtown and surrounding areas, which are at least 95% occupied. The project will most likely be buildings with 6 to 75 units each and feature a mix of market rate and moderate income housing. Condo, loft, and apartment housing in downtown and Midtown, that's Wayne State University District, are areas essentially sold out. Young professionals with bachelor's degrees living in downtown Detroit has increased by 59%. President Barack Obama sent members of his administration and his cabinet to Detroit on September 27th. They announced $300 million in grants from the federal departments, along with commitments from the state of Michigan and foundations to be used for residential and commercial demolition, neighborhood revival, hiring of police officers, hiring of new firefighters, repair and rehabilitation of city buses, and money for other transportation needs. In conclusion, Detroit and our financially troubled American cities can be saved. They all and will have bright futures. Thank you.
Thank you very much, and for that encouraging perspective. And with that, I'd like to reintroduce Mary Francoeur.
Okay, great, thanks. Good morning, and thank you to Peter and to Mayor Archer, and to Dennis for inviting me here today. I'm very pleased to be here before you. What I'd like to do today is sort of walk you through who Assured Guaranty is, talk a little bit about bond insurance and how it operates, try to make it not too much of an infomercial, so I'll move through these slides fairly quickly and actually spend most of my time on pretty much my last slide and talk there mostly on the perspective of how we're looking at the current state of America's cities and what we think about them from a credit standpoint. But just, pretty briefly, Assured Guaranty is a financial guarantor. Our parent company is based here in Bermuda. This is my first time here, though. And as a financial guarantor, basically what we do is guarantee the full and timely payment of debt instruments. And so when a borrower borrows money, we insure those bonds to the extent that that borrower defaults on that payment. We make sure that bondholders get full and timely payment. So in effect, we're a credit business. I actually rode in from the airport yesterday with someone who works for State Farm, and I was sort of discussing with her the difference between a property and casualty company and us. And we look at risks very differently. A property and casualty company looks at the likelihood of events happening and having to pay a claim. To a certain extent, we look at the likelihood of events happening and having to pay a claim, but at the end of the day, we also become subrogated to the rights of bondholders, and so to the extent that there is a default on a bond payment, we not only pay that claim, but we also enforce the rights of the bondholder and seek to collect payment under that default. We have a very strong capital base, and I'd actually like to walk through some of the numbers here. I'll go forward and then go back. We do operate under 4 discrete operating companies, and they have separate capital bases. Our main platform for writing business right now is Assured Guaranty Municipal Corp. That's the company that was formerly known as Financial Security Assurance, or FSA, which Assured Guaranty acquired in July of 2009. And that's where we write most of our business. And most of our business is actually, 95% of our business over the past couple of years has been guaranteeing the debt of municipalities, states, school districts, local jurisdictions in the United States. We have over $12 billion in claims-paying resources. But what I'd like to point out to you is that against those $12 billion in claims-paying resources on a consolidated basis, we have debt obligations that we insure of just under $500 billion. And so when you think about it from a leverage standpoint, our net par outstanding to our statutory capital is 76-1. We're a leveraged business, but we're a credit business. And so at the end of the day, what's most important to us is our ability to underwrite, to assess the potential for risk, and maintain sufficient resources to pay claims when they come due, when we're surprised, just as the rest of the market is surprised by a default on a bond. But for the most part, what we do is we evaluate potential credit risk and really only insure bonds that we believe provide limited to no risk. So I'm going to go back again to our operating principles. So the most important thing for us is our risk management, our credit underwriting, and the analysis that we do when it comes to evaluating the potential that a particular bond that we're looking at is going to default. And so what does this do for the bondholder? It helps to homogenize the risk. There are 80,000 local governments in the United States in various forms, starting with the 50 states down to, I live in the state of New Jersey. There are 565 municipalities in the state of New Jersey. There's over 600 school districts. There are 15 counties. There are numerous special authorities, and they all issue debt. And that's just in New Jersey. You multiply that across the United States, you have 80,000 distinct governmental units, most of which have the authority to issue debt that's an obligation of only themselves, that's non-recourse to any other level of government. And so how do you know who that borrower is, especially if you're a small muni shop or small investor? What happens with bond insurance is that we do that credit risk analysis for you, and we also provide you that financial guarantee. We homogenize the risk so that you don't need to do the evaluation on an individual basis. The other thing, as I mentioned before, is that we do enforce obligations. We're there. There could be, and I'll talk about this later, we're in the process of enforcing our rights and rights of bondholders generally in a number of instances right now, and we have the resources to do that. We spend a lot of money on attorneys right now dealing with some of the workouts that we're addressing. We have, as you saw on the slide with our capital resources, we are operating under several different platforms. Assured Guaranty Corp., Assured Guaranty Municipal, and Municipal Assurance Corporation are the three platforms that we use to write direct business. We also have a reinsurance company that provides reinsurance to our direct platforms and to other financial guarantors. Assured Guaranty Municipal is our largest platform, and while it historically has done both municipal as well as structured finance and also international finance, right now it's mostly just focused on municipal business in the United States. We're only writing new municipal business out of that platform, as well as international infrastructure. We just launched Municipal Assurance Corp., MAC, earlier this year, earlier this year, and that platform is going to be directed towards the small bank qualified market in the United States, intended to really provide a clean municipal platform. It's going to be municipal only, and it won't have some of the residual of the structured finance portfolio that caused a lot of the former actively writing municipal financial guarantors to no longer be writing business. I could give you a history of financial guarantors, but I'd really rather not, because sometimes it gets painful. So let's talk about our municipal portfolio. And again, it really speaks to underwriting discipline. Our public finance group has a staff of 30 analysts between our offices in New York and in San Francisco, and their job is to basically evaluate each of the transactions that we look to underwrite. Depending upon the nature of the credit, we'll spend anywhere from a day to 3 days to weeks, depending upon the risk profile and the newness of the structure. Most of our portfolio, again, most of our business is in U.S. public finance. It's over 3/4 of our outstanding book of business. And as we look at things across the different platforms, you'll see that we get more and more municipal at Assured Guaranty Municipal and Municipal Assurance Corporation. A little bit about our market over the past couple of years. Bond insurance at various points in time had been over 50% of the market, the municipal market in the United States. It has since declined as a function of the fact that there used to be 7 active monolines writing business. Now there's basically 2, and the other bond insurance company that's currently operating is actually relatively small. We're a full-size, full underwriting capacity. We write in all sectors of the municipal market, from school districts to healthcare, publicly owned hospitals and not-for-profit hospitals. But over the past few years, the insured market has shrunk really as a function of credit spreads. And as spreads tend to widen out, there's more room in there, because basically our value proposition to the issuer, who is the purchaser of our bond insurance, is how much we save them in spread savings. Right now, Assured Guaranty has ratings. These are our current ratings. So basically, when we insure a bond, that bond gets the S&P AA- rating from on either Assured Guaranty Municipal, MAC, or AGC. Our new platform, Municipal Assurance Corporation, has a AA+ rating from Kroll. Kroll is a ratings agency that is just getting started, and they've evaluated us and assigned a AA+ stable outlook rating to our new platform. This is just a slide over the credit spreads over the past couple of years, and where the value of bond insurance basically plays is raising the credit quality of bonds from their underlying rating to the insured rating, and reducing the interest cost. And so where we get compensated is through that spread differential. Our premium basically takes a portion of that spread, anywhere from a quarter to a half to a, 2/3, depending upon the nature of the transaction and how much value we add to it. Just wanted to go back. And this is an example of some of the transactions that we've insured in the past year. And it includes a variety of school districts, hospitals, toll roads, cities, counties, airports, basically throughout the United States, and state credits. A little bit more about our portfolio. This is our overall portfolio is just under $500 billion in debt outstanding. Again, most of it, 3/4, is in U.S. public finance, and most of that is, 44% of that is for general obligation bonds, other tax-backed, and then a variety of utilities, airports, toll roads, other infrastructure financings, as well as healthcare and other 501c3s, nonprofit corporations. And then a little bit more detail on the public finance portfolio by rating. Most of our portfolio is rated at least A. And then we also have a fair amount, just a small portion of our portfolio in the U.S. public finance is rated in the BBB categories, and less than 1% is rated below investment grade. And I think that's an important point to bear in mind. And these are our internal ratings, which is that, the public finance market tends to be a solid credit quality market. And most of anything that we've insured, because we generally look for underlying investment grade ratings on anything that we insure. Anything that's gone below investment grade has had credit deterioration since we insured it. So insuring America's cities, those city and town general obligation debt basically represents about 6% of our entire insured portfolio and 8% of our municipal portfolio. It goes across the board. Speaking back to those 80,000 municipalities, we have over 2,000 names in our portfolio. While some of our exposure runs over $1 billion, and that would include places like the city of Chicago and Philadelphia, our general obligation exposure to the city of Detroit is actually, as the mayor had indicated, about a little over $300 million. But for the most part, you have, among those 80,000 levels of government and the 2,000 cities and cities that we insure, a lot of small places. We insure debt, ranging from $1 million to, like I said, over $1 billion for, some of the major cities in the United States. And so our average exposure to any one name is about $15 million. And to a large extent, that's one of the things that enables us to maintain our claims paying resources. We have a real diversity in terms of our book of business. But I'd like to speak a little bit, and this is where I'm going to spend most of my time, is talking about our underwriting focus and what becomes important when you're evaluating cities especially, because of a lot of the operating pressures that they speak to. Every now and then I teach a public finance class for my alma mater, and the first question that I ask the students is, so what does the United States Constitution say about local government? Anybody? Anybody? Nothing. Big zero. Absolutely nothing. And so anything that a municipality does is a function of what it's enabled to do by its state constitution. A lot of municipalities have home rules so that there's not as much direction from the state, and they've got a fair amount of flexibility. But for the most part, anything that a city does is enabled through state law and then local law. And so a lot of what we focus on is, especially when we think about financial flexibility and statutory authority, is that how can they raise revenue? There's taxpayers, and then there's credit analysts, and credit analysts look at things like tax limitation measures as probably the worst thing that could ever happen to a municipality, because it basically eliminates their flexibility, both in spending caps and especially revenue caps. So when California, passed Proposition 13 and limited the ability to raise taxes, that was a big problem in the municipal market because they no longer had any revenue-raising flexibility. And then we look at things like the economic and tax base. And even if you have revenue-raising flexibility where you can raise your tax rates to an unlimited level, sometimes you can't get blood from a stone. You can only get so much from your economic base as will enable you to cover your operating expenses and repay your debt. And so one of the things we also look at are things like debt management and one of the things that we're especially looking at now is really focusing in on pensions as just another form of debt, a form of debt that might have some more payment flexibility than a principal and interest schedule on your bonding, but for the most part it is an obligation, and it's a long-term obligation. And then capital improvement program, are you reinvesting in your community? And if you're not reinvesting in your community, what does that mean for your long-term viability from an economic standpoint? So these are all a lot of the things that we look at. I mean, we have a whole slew of questions that we as analysts focus on when we're thinking about whether or not we're going to take on exposure to a particular name. So let's talk about some of our problem children. When we look at, I'll speak to a handful of these, although there's a lot of things that are currently in process right now that I really can't speak to. But sometimes things go wrong. And we have a couple of instances now where some of the debt that we've insured is either defaulted or the issuer has filed for protection under Chapter 9 of the Bankruptcy Code. So Jefferson County, Alabama issued a bunch of debt for their water and for their sewer system. And these sewer warrants, a couple of things. So Jefferson County had been under a consent decree with the state DEP and the US EPA because they needed to address some deficiencies in their sewer system. And it was going to be very expensive for Jefferson County to address it because of their topography. They were going, they were going to have to pump their wastewater into their wastewater treatment system because they couldn't use gravity flows. More information than you wanted, I know, but just to put things in perspective. They issued a lot of debt in order to fund it. But it wasn't just the fact that they issued a lot of debt. What they were really trying to do was moderate their rate increases and keep them as low as possible. And so one of the things they did was a lot of financial engineering, a lot of short-term variable rate debt with swaps. And when the financial crisis hit, a lot of the swaps and things like that blew up. And so all of a sudden, 30-year debt and 40-year debt now became 5-year debt when some of their variable rate debt that had liquidity facilities on it became bank bonds, and the banks were requiring that debt that was, again, 40-year debt now be repaid in 5 years. So there was a default. We've actually been working with the Jefferson County, along with other bond insurers, because just about all of their debt was insured, to work through these issues, and there's actually now finally a plan at the table. And so they would cover most of the debt, pay bondholders, I think 60 cents on the dollar if you're an uninsured bondholder, 80 cents, sorry, I got that flipped. But basically there is a workout on the table. Assured Guaranty will take a loss associated with this transaction, but it'll be a fairly moderate loss as far as we're concerned, and we believe that we've actually worked through a reasonable outcome. The City of Stockton, we've actually now are just coming to an agreement with the City of Stockton. We had obligations. We have 2 obligations that we insured for Stockton. One was a pension obligation, generally a general fund obligation that the city would pay from their resources. They actually issued bonds to fund their shortfall in their pension. And if you're familiar at all with what's going on with Stockton, there's been the major issue there is whether or not they were going to pay their bondholders or whether they were going to continue to make their required contributions to the California Public Employees Retirement System. We were under the belief that we were equal partners. There have been some issues there kind of going back and forth, but we believe we've struck a reasonable agreement with the City of Stockton, and we will not incur any losses there. We also had a building that the city had funded with some debt, and we've actually taken repossession of that building. So in that instance, we actually had recourse to a piece of collateral that will enable us to repay, to not incur any losses there. And then finally, the city of Harrisburg, Pennsylvania, had built an incinerator. They didn't have enough money the first time, and so they had to issue more debt to finish the incinerator. It was an incinerator that they couldn't afford. They in Dauphin County, where Harrisburg is located, basically guaranteed that debt obligation equally, but it was not an affordable debt obligation. And when the incinerator didn't make money, the bondholders looked to the city's obligation to get under that guarantee, and that was the main issue in terms of the city's default on that debt. Again, we believe that there's a workout there, and we are enforcing our rights in that instance. But one of the lessons learned from Harrisburg, particularly, is that a lot of the times municipalities will fund a project that they expect to be self-supporting. They will do it with their lowest cost of capital, which is their general obligation debt, with the guarantee, although with the expectation that they won't have to seek to raise taxes in order to cover that debt obligation. But in the instance of Harrisburg, and I've seen skating rinks, golf courses, arenas, where the money that it was supposed to make and to be self-sufficient was never self-sufficient. They're not self-sustaining. And so all of a sudden the municipality has guaranteed this obligation, and now the bondholders are coming back and saying, well, you guaranteed it, pay me. And they're like, well, we don't have the money for it because we don't want to have to raise taxes for it. So that's one of the areas where you tend to see municipalities get in trouble. Anyway, the message here is that there are issues, we experience them, we have sufficient resources when we do need to pay claims, but the most important thing I think for us is that we do go out and we enforce the obligations against those who choose to default on their debt. A little bit more information about our contacts. This is all in your program, and I appreciate your time. Thank you.
Thank you, Mary. Thank you very much for that excellent overview. So we have time for a few questions.
The question's for Mayor Archer. In your governing experience, and in the context of there being 80,000 governmental entities across the U.S. That have the potential to do this, did anybody in Detroit, or does anybody in any of those 80,000 different jurisdictions have the wherewithal and analytical capability to understand the interest rate swaps market to avoid the disaster that happened in Detroit and in other places?
I think there is lessons to be learned by what occurred from the city of Detroit and what occurred there. And by working with the rating agencies and depending upon the rating that the city or municipality or county has, if there's a need for insurance, you can also work with great insurers to determine what would be in the best interest so that you can walk into this thing with your eyes wide open. We learn from mistakes. I will tell you just as an aside, speaking of insurance, when I first became mayor of the city of Detroit had junk bond status. And the only way we could sell bonds or get to the bond market was to go to insurance companies to make it happen. And we were able to come from junk bond status up to A ratings with Fitch and Standard & Poor's, and we were just below A rating with Moody's. Everybody moved us up because of our fiscal responsibility.
Could I ask a general question? Is there a role for the Affordable Care Act to take on some of the city's healthcare liabilities, especially after a Chapter 9 filing? And if so, what is the process? Who in the government would make that decision or determine if that decision is to be made?
Well, in the case of the city of Detroit, they have, if you follow the newspapers at all, the governor has already employed, and with the city's responsibility to pay, outstanding consultants and law firms that can look upon the opportunity to get through bankruptcy and to cause the city to be able to afford to hire police officers, keep the lights on, provide city services. I do know that the emergency financial manager, Kevin Orr, is looking at utilizing Medicare as a solution for health care for retirees. So there's a lot of things that are being looked at, including the Affordable Health Care Act, yes.
Oh, sorry, Mary. Yes, I apologize.
I would add that what we see is that OPEB, the other post-employment benefits, and also current health benefits, have less sort of statutory provisions, and so most municipalities can actually address their health care costs with changes in plan specs kind of on a going forward basis. And so the Affordable Care Act is one alternative, but I think a lot of municipalities have the authority to adjust their healthcare programs in order to address that cost mechanism. I wanted to respond to the question about the interest rate swaps. From where I've sat, I mean, I've seen school districts in Pennsylvania do swaps that they had no ability to enter into. I think that it's very easy to be sold a bill of goods. I think that there are, of those 80,000 municipalities in the United States, many of them are very sophisticated and very capable of managing debt in a manner that enables them to afford themselves access to the broad range of financial instruments. There are a lot of municipalities in the United States that have entered into swap agreements that never should have done it in the first place.
Please, sir.
I'm from California, and the public employee unions are extremely powerful on a state and local level, to the point where the politicians have no interest in talking about these extreme pensions that are being promised down the road. Do you see this nationwide, and at what point does it all blow up?
Well, I think as the Pew Foundation had uncovered or disclosed or shared with the American people, their findings that there was an unfunded pension fund of some $90 billion and $118 billion in terms of health care. I think because having come from the city of Detroit and having in our home state, or in my city, the United Auto Workers as a very powerful international union, and they, by the way, just as an aside, represented our law department. Our lawyers were unionized as well as, which was an interesting discovery. But the point is that I look at the UAW and what they did to help save the automobile industry. And not only they, but another union has done the same thing, is the Teamsters. So if our public unions would follow and understand what has occurred in the private sector, where it was important for businesses or unions to work with the businesses, I think you'll find a stronger acquiescence in negotiating out and going from a defined contribution with huge payouts, because sometimes cities or states and counties engage in collective bargaining and feel that it's better to give more in pensions than cash bonuses or pay increases, and they find themselves in a real dilemma. And when you can't afford to pay it, like the city of Detroit, we've got 2 retirees for every one that's working. For those who live in cities that had steel industries, when they had 3 retirees for every one, and when General Motors had and Chrysler had 2 for every one that was working, it's on a huge collision course. And at some point, if nothing's done, you're going to run out of money. And so you're going to have to make some adjustments.
Mary, did you want to? respond to that?
So to put pension obligations in perspective, in 2007, most pension fund systems in the United States were probably at least 75% funded, right? So and then in the 6 years since, you've had significant loss in investment value, right? We all know that. And then the other side of it is that the financial squeeze that a lot of governments have been on over those past 6 years have also caused them to reduce their contributions, which is why so many of them are so underfunded. So the problem is sort of a recent problem. It doesn't mean that it's not a problem, and to a certain extent, I think one of the things that's happened over the past couple of years, it's caused people to think more about having a defined contribution plan versus a defined benefit plan, because that's really where the issue lies. At the end of the day, it's a matter of sort of riding the ship today. I don't think that there's a lot you can do about existing retirees and beneficiaries who have been in systems and are currently vested. But going forward, I think a lot of governments are looking at restructuring their plans going, for forward obligations.
Okay, good. We're going to have time for 2 more questions, and Jill, would you?
Yeah, this is just a quick question for Mary. Just given what happened to the monolines post-crisis, during the crisis, are you guys able to buy reinsurance policies on your potential liabilities? Or were you able to before and you're not to, and it's not economical anymore?
So there's not a lot of, a lot of the reinsurance had been from monoline to monoline, and then there are a number of reinsurers. Right now there is really no reinsurance in the municipal market because we're the only monoline really operating, so. Yeah.
Okay, one more. I don't know if the microphone is on. Sorry.
Question for Mary. You mentioned earlier about sports stadiums and similar kinds of projects. Do they merit special attention when you're doing your underwriting because they're not in the usual class of public goods like highways, water supply, et cetera, et cetera?
They do. We look at the sports facilities are generally funded, supported by governments because of the economic development benefit associated with them. And there is some, although the economists will argue that it's, maybe break even in terms of the cost versus the benefit. We have actually insured stadium projects, but a lot of them are self-funded through user charges, naming rights, those types of things. When we look at a sports facility, we really look to whether or not the government does expect it to be self-sustaining, even if they've put their tax-backed resources towards it, but actually really underwrite it on the assumption that they will have to access their tax-backed resources and basically make sure that they acknowledge that obligation because we do expect that they won't be self-funded.
Well, with that, I'm sorry. I know several of you have questions. I'm sure our panels will be delighted to spend a few minutes after the presentation, but thank you both very, very much.
Wonderful discussion about cities. The takeaway, and we're going to go to a coffee break for 15 minutes or so, and I'm sure that we'll engage in conversation. Interesting takeaway. Dennis put the crisis as part of the sequence of events to get to the growth phase, and Mary is in the business of insuring against the crisis that's part of the sequence to get to the growth phase. And over coffee, both of them, I'm sure, will discuss that in great detail. So let's take a 15-minute break.